I suppose it's fair to say, in my sister's account, I have no career risk. She isn't going to fire me.
Ever since legendary investor Jeremy Grantham told WealthTrack how he kept his sister's money safe during the financial crisis, I have wondered, what about all the other women, many of them divorced, widowed, or lifelong singles who don't have Jeremy Grantham to call upon? Well, we've started a new feature on WealthTrack's website called WealthTrack Women. On a regular basis, investment pros who specialize in advising female clients will answer questions vital to the financial health of women. Look for it on wealthtrack.com. This week on WealthTrack, contrarian money manager Steve Luthold invests in businesses many investors consider to be toxic, including uranium mining companies and Chinese water and pharmaceutical firms. Great investor Steve Luthold explains his unusual choices next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Look at just about any market's performance anywhere around the world since the financial crisis, and the U.S. market will come out near or at the top. It has been a great time to be invested in America. Where would you prefer not to have been over the last 5 years? Well, one place is China, which, as you can see from this chart, comparing the Shanghai Composite Index with the S&P 500, has vastly underperformed the U.S. market. If you take it down a level to industry sectors of the market, one area you would not have touched with a 10-foot pole is uranium. Stocks of uranium companies, as measured by the Global X Uranium ETF, have plummeted since the ETF's launch in late 2010. Well, why on earth would I choose to highlight China and uranium? Because those are two of the major areas where this week's guest is investing. And there is a reason he has been called a contrarian's contrarian. He is Stephen Luthold, and he comes by his independent streak naturally. He hails from Minnesota, what he refers to as the North Country. Indeed, for 3+ decades, he published his monthly View from the North Country report for institutional clients. He also founded and ran a leading independent institutional research firm, the Luthold Group, which was known for its quantitative research and asset allocation. He started an investment management arm there, creating several mutual funds under the Luthold name and overseeing $5 billion in assets under management at its peak. Then a couple of years ago, he decided to call it quits from the tightly regulated mutual fund business, although he remains a major shareholder at his old firm. He also wanted to escape from the pressures of managing billions and his grueling publishing deadlines. So last year, he launched Luthold Strategies, a small private investment partnership geared to high net worth individuals and requiring a minimum investment of $500,000. With a little under $100 million under management now, Luthold plans to cap it at around $500 million. Although most of us can't invest with him, Luthold is still worth listening to. I asked him what he is doing differently at Luthold Strategies.
We look at things differently. We look at investing in themes, and many of those themes are contrary to the consensus. And if you had to run them through a committee, you'd get 10 no's and 1 yes, and the yes would be mine. And so I developed the themes. To give you an example of this, for instance, a lot of people look at the new high list and they want to get the stocks that have the best momentum. Well, when we're initiating a position, we look at the industry new low lists, and then we search in those types of industries for some reason that could turn them around and make them look better. I mean, the airlines were a perfect example 2.5 years ago. And then when it comes to time to sell them, we also look for a bottoming from a technical standpoint too. But then when they move ahead, then we become momentum investors and we stay with them as long as they keep going up. Because our goal now, because we're running it for individuals, is to make sure and try to get long-term capital gains on everything we do. It's not just the performance numbers.
Steve, in a recent letter to your shareholders, you told them that you expect a steep market correction. Why do you expect that? How steep?
Well, there's no magic way to determine that. I merely looked at how far the market has gone over the last 2.5 years, and then we do a value analysis, and we find that the S&P 500, as an example, is now in the 90th percentile of its historic valuation in terms of normalized earnings. And the odds of having a large gain from here are not really very good. And so from a value basis, we think the market is, at least the one in the United States, is overvalued because it demonstrates that. We've had the market go up over the last year, and you've had the market go up like 20–25%, and corporate earnings have only gone up year over year about 2 or 3%. And so all of it's been a play on psychology in terms of this last move. And we look at this and we say the odds no longer favor things going a lot higher than we are right now. And as a result, I think if we were going to have a normal correction, and we've never had a reasonable correction for the past 2.5 years, I think we're probably due for one.
And you're getting more defensive in your portfolio, correct? So how do you do that?
Well, we have some themes that are in themselves defensive. For instance, I've been worried about a reemergence of inflation for probably 6 months, maybe longer than that.
And I will say that you're called the contrarian's contrarian, and one of your contrarian major themes is this concern about a resurgence in inflation.
And right now,
where no one else seems to be concerned about inflation, and you've got what, 20% of your portfolio in inflation hedge type.
But now they have started to be a little concerned about it. So but I think we sit with 10% of our portfolio in gold, which we view as that, and we have another 5% in a commodities fund that we think is well managed and can be a very effective hedge against inflation. It's got 20 different commodities in it. They rebalance it.
And this is the Greenhaven Continuous Commodity Fund?
That is right.
And I want our viewers to know also that your holding in gold is GLD, the ETF that actually holds gold.
Right. We also had gold with the mutual funds, but there we didn't have GLD. We had the actual physical gold. We had to go up and look at it. Our compliance guy had to go up and look at it. But no, this is the GLD, which is, I think, is just as good, but it's not derivative based. It's based on the actual holdings of gold, and they have to sell gold when they have net redemptions and so on and so forth. So we're satisfied with that. So we've got a little bit of Rio Tinto, and we've got a little bit of BHP, which are traditional kind of inflation hedges. So I don't know if this is going to happen or not. But I think there is a possibility when we look at what's happening in terms of the printing presses around the world, whether it's in the United States or whether it's in Euroland or whether it's in Japan. They're all printing currencies. And to me, when we've done studies of inflation, when you start expanding the money supply by too great a level and artificially, which is being done, it has in the past led to inflation and sometimes very, very serious currency debasement inflation, a la Germany or a la Mexico or whatever. And I'm not saying we're going to go that course, but it's going to become an increasing fear. And because it's a fear, the stock market's going to react to it eventually, sometime in the next year, I think. And that's one of the reasons we think the market could correct by 15%.
Another contrarian theme that you have as well is China. You are actually bullish on China. Why China?
Well, it's pretty simple. Economic growth, whether it's reduced to 6% or it's 7.5% that the bulls look at, it's 3 to 4 times what it is in the United States. When you look at the PE multiples, it's half of what it is in the United States. So here we have a fast-growing economy with management so far that's been very reasonable in what they've done, even though supposedly it's communistic. And to me, you're looking at a country. I mean, I've been to China. I've spent time in China. I see what's happening. I see the miracles. I was there in the Olympics and so on. I see a country that on the international basis is really being picked on all the things they might be doing that's wrong, the overextension in the housing area and so on. But if you compare them and then the assets that the government has compared to the U.S., they have the ability to withstand that with government spending. And I think when we look at China, there's 2 areas. We have a couple of broad mutual funds we have that are well managed. One is the Matthews Fund.
Matthews Asia.
Yes, right.
And
then we also have Fidelity, China Region Fund. Those are well managed, but we are then focusing. We've got another 5% in, well, they're in China water stocks. China has you think the U.S. has water problems. If you look at northern China, you have really serious water problems there, and problems with companies that are recycling wastewater. So we have things like Beijing Water and other Chinese-focused water stocks.
Sound Global is another
one
that I saw in your portfolio.
That's right. Mm-hmm. And in addition to that, we are interested in what China is doing in developing their own pharmaceutical business. They're starting to kick out some of the U.S. big drug companies that are at cooperative agreements, and they're trying to develop their own. So we've got another 5% of the portfolio in some emerging pharmaceutical companies in China that are based in China. And when you look at it, China is spending like 4 or 5% at the most of their GDP on health. In the U.S., it's 18 and 19%. And there's a lot of room for growth, and they also want to establish themselves as the pharmaceutical center of Asia with their own products. And to us, it looks like a real opportunity, and they're going to pour a lot of money in developing that thing, and the same in terms of the water conservation stocks. The one big thing that the China leadership has said, and they're responding to the people, is this whole thing about air pollution in China, where the measure of air pollution in Beijing is 8 times that of Los Angeles. And you've had 1.5 million people per year die from bad air.
In China.
In China, that's right. And if you look at the average lifespan in China, in northern China, it's fallen by 5.5 years.
It's stunning because of pollution.
Because of pollution. And that leads us right to nuclear power, which is another thing that, although the U.S. is paranoid about radiation poisoning and so on and so forth, they're not paranoid in China. I mean, you've got 49 plants that are now under construction, nuclear plants. There's another 71 that are in the planning stage. And the same is true in India, that has the same pollution problems. I mean, the government in China has said, this is our major problem. This is the thing that we really have to deal with, that the public is the most concerned about here. And it may
And they're doing it.
I hate to sound like a bull on China, but I am. I think it's going to be, over the next 3 years, it's going to be the best performing major stock market in the world.
And you heard it here first from Steve Leuthold on Wealth Track.
I said the same thing last year, though.
Maybe this year will come true.
Right.
Steve, another big investment theme, and you've just alluded to, actually a couple of them, is clean energy, and which sounds very PC until you find out that you, Steve Leuthold, as you just mentioned, are investing in nuclear.
Right.
In companies that are involved in nuclear plant design and uranium, and so explain the nuclear piece as a clean energy theme.
It is because, you know, some people may think that's radiation pollution. I mean, that's what people are phobias about. But there isn't any air pollution. There's not any particulate like you're getting from coal or anything like that. So the people that look at it in terms of air pollution rate it the cleanest that they can possibly have. And we're seeing this become extremely important for countries that are faced with a huge, huge pollution problem. I mean, we've addressed part of that here in this country, but you have a long way to go in India, or you have a long way to go in China. And so I think that can be viewed as the cleanest of clean energy. Now, solar and wind may be as good, but they can't produce the amount of electricity that you can see. Even England has hired Areva to come in and build a new nuclear plant in England.
Now, this is a French nuclear plant designer.
Right.
Areva.
Areva! No, it's a French company. It's owned not all by the French government, but they own like 45% of it. That makes us a little hesitant, but we like the business that they're in, and they have a really good reputation around the world in terms of designing nuclear plants and so on.
And then there's a uranium miner based in Canada also that you own called Cameco.
Right, which is probably the one the institutions would buy because it's the biggest publicly held uranium miner. The Russian government is bigger. The Canadian government is probably involved in more of that than other people, because that's where most of the mines are, and you also see it in countries in Southern Europe and in Africa. So there's a lot of nuclear yellow cake, which is what we're talking about, around to be mined. The problem is, after the Japanese disaster, Fukushima, which was like 3 years ago, the Japanese, which are perhaps understandably more concerned about nuclear power because of what had happened to them in World War II, but they have been really reluctant to restart some of their reactors that they should have been restarting by now. And as a result, they have part of their stockpile that they're selling into the marketplace. So since before that event, you were seeing nuclear yellow cake selling for about $90 a pound, and now it's down to about $28 to $30 a pound.
Wow.
And
cyclical.
Most of the miners are unable to make money at it at those levels. So you set down a lot of the production. Now, some things are going to happen over the next 3 years that, especially with the new plants coming on, and with maybe China or maybe Japan restarting, because they're finding that their electrical production, which is now based on LNG primarily, is far, far too expensive, and electricity rates have gone up like 2- and 3-fold. So I think that long term, this is a 3-year play. We know this is going to take some time, but there is a growing demand, and there is currently a very low supply of what they need to fuel the REITs. I think there are about 700 reactors in the planning stage, not just in the building stage. So you're going to see
demand pick up for both of those areas.
Maybe even in the nuclear-phobic United States. I don't know, but we do have another part of that clean energy, which is more conventional, and that's we've got about 12% or 13% that is in natural gas. And natural gas is not super clean, but it's a lot cleaner than what we're looking at now, and it's a good step, I think, toward dealing with our own air pollution and other countries that can afford and develop natural gas. I mean, we're not the only one that can do this. We're not the only fracker around, you know. Mm-hmm. And so that's the other step, and that's kind of the intermediate step, and those stocks are pretty cheap and they're pretty productive, and we like that area too. And it's not as radical as the nuclear, but that's a longer term bet.
Airlines quickly have been a major investment, a very successful one over the last couple of years, and you have said to shareholders may now be a sale candidate.
We looked through all the industries and the ones that were at the bottom of the heap, and airlines were at the bottom of the heap. People said they've never made any money, I wouldn't touch an airline, and so on and so forth. You heard all this, but you were forming a pretty good relative strength bottom in the group. So we started looking at it as to why we might consider buying this. And we went through some of the rationale, and they seemed really cheap, and we bought them. And it's like, once in a while you strike gold.
With Delta and American.
And American, and we did have Southwest, we had 5 or 6 different airlines at one time, and now we've concentrated it in the 2 best performers, and now we don't see any sense in bailing out just because they're overpriced, as long as they keep going up. And therefore we've become from value investors to momentum investors with this, with this particular.
And when they stall, you will get out.
Yes, we will.
So Steve, we ask every guest at the end of Wealth Track if there's one investment that you could own in a long-term diversified portfolio, what would it be? So what would you recommend for our one investment?
Well, right now I would recommend an inflation hedge. And that would be the fund that we talked about earlier.
Which is the Greenhaven Continuous Commodity Fund.
That's right. We just have invested in that for the first time in the last 2 weeks, because we went through and we looked at all the different potentials that are ETFs that everybody could use. And this one is based on 20 commodities, and it's equally weighted and rebalanced in those 20. And it includes food as well as minerals and metals and so on and so forth. And it's probably the best balanced one that we've ever seen in looking at them. So
we will
I hate to be running a commercial for them, but it is really, it deals with a lot of the problems a lot of the commodity ETFs had in the past.
So Steve Littlefield, thanks so much for joining us on Wealth Track. It's great to have you back.
It was my pleasure.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point recalls one of my favorite pieces of advice from one of the great financial journalists of the last century, who appeared exclusively on Wealth Track. The late Peter Bernstein told us that you are never truly diversified until you own something you are uncomfortable with. So this week's action point is own something you are uncomfortable with within reason. My choice would be gold, which Bernstein considered to be a core portfolio position in small amounts to hold as an insurance policy against disaster. It is also considered to be an inflation hedge. Steve Luthold's choice of the FTF Spider Gold Trust is as good a way as any to own the metal. It's also a lot cheaper than it was at its peak in 2011. Well, next week we will sit down with a Wealth Track regular and widely followed strategist. Nuveen Asset Management's Bob Dahl will join us with his investment outlook and strategy for his large cap funds. Also, in our new Wealth Track Women section, we will have updated financial advice specifically for women from our panel of women financial advisors. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation.